Ever felt like the stock market is speaking a language you don't quite understand? Bull markets, bear markets, it's like trying to decipher a secret code, isn't it? Now, you might think that these animal-themed market trends are just Wall Street jargon that doesn't really matter to everyday investors like us, but here's the thing. Understanding these trends can be crucial to your investment strategy. What if I told you that getting to grip with bulls and bears could help you make smarter investment decisions and potentially grow your wealth over time? That's exactly what we're going to chat about today. I'm Aisha, your friendly neighbourhood economist, and today we're going to simplify bull and bear markets. Don't worry if you can't tell a bull from a bear in the financial wild just yet. By the end of this video, you'll be spotting them like a pro. So let's dive in. First things first, what exactly are bull and bear markets? Well, think of a bull market as the life of the party in the financial world. It's when stock prices are rising, investor confidence is high, and economic conditions are generally favourable. The term supposedly comes from the way a bull attacks, thrusting its horns up in the air. In the same way, a bull market is pushing stock prices up. On the flip side, a bear market is like that friend who always sees the glass as half empty. It's characterised by falling stock prices, pessimism, and negative investor sentiment. The bear analogy comes from the way a bear attacks, swiping its paws downwards. Similarly, in a bear market, stock prices are heading down. Now, let's dig a bit deeper into what defines these markets. Typically, a bull market is defined as a period when stock prices rise by 20% or more from recent lows. Bear markets, on the other hand, are defined as periods when stock prices fall by 20% or more from recent highs. But it's not just about the numbers. Bull markets are often accompanied by strong economic indicators like low unemployment, rising corporate profits, and increased consumer spending. It's like the economy is a well-oiled machine, just humming along, doing its thing nice and smoothly. Bear markets, on the other hand, often coincide with economic downturns or recessions. You might see rising unemployment, falling corporate profits, and decreased consumer spending. So in this scenario, it's as if the economy is caught a nasty cold. Now, why should you care about these animal antics in the market? Well, understanding whether we're in a bull or bear market can help you make more informed decisions about your investments. In a bull market, you might consider investing more in stocks as prices are generally rising, holding on to your investments to potentially benefit from further growth, looking for opportunities in sectors that tend to perform well during economic expansions such as technology, being cautious about overvalued stocks. Remember, even in a bull market, not every stock is a good buy. During a bear market, you might think about being more cautious with new investments, focusing on defensive sectors that tend to weather economic downturns better, like utilities or consumer staples, ensuring you have a well-diversified portfolio to help cushion against market falls, looking for bargain opportunities. Some great companies might be on sale. Now, here's where it gets interesting. While bear markets can be scary, they can also present opportunities. Remember the saying, buy low, sell high? Well, bear markets are when stocks go on sale. If you have a long-term perspective and you believe in the fundamental strength of the companies you're investing in, bear markets can be a great time to buy stocks at a discount. In fact, let me share a personal experience from the COVID-19 market crash. Knowing that the downturn in the market would likely be short-lived and artificially depressed, we decided to buy shares in sectors we believed would increase in price after the crisis got under control. So we opted for pretty safe bets as we saw dips across the board in all sectors. For example, we invested in companies like Disney, cruise ship operators, and Rolls-Royce. We've held on to these investments since then and it's paid off. As an example, the Rolls-Royce share price has gone up by 40% since we bought it. Now, this experience really drove home how helpful it can be to understand the landscape and recognise that dips are often short-lived. It allowed us to take advantage of the market in a way that has been beneficial for our portfolio. Now, I want to be clear, this strategy involves risk and it's not for everyone. It requires a good understanding of the market, a tolerance for risk, and the ability to weather potential short-term losses. So this illustrates an important point. Bear markets, while challenging, can create opportunities for those who are prepared to have a long-term perspective. But here's the thing, and this is where my economist hat comes on. Trying to time the market based on these trends is about as easy as predicting the British weather. Even the experts get it wrong. Right, let me share a bit of economic theory with you. There's this concept called the efficient market hypothesis, and it suggests that stock prices reflect all available information at any given time. In other words, the market is always right based on what we know at that moment. If the efficient market hypothesis holds true, and there's plenty of debate about this among economists, it would mean that it's virtually impossible to consistently beat the market by timing your investments. It's a bit like trying to outsmart the collective wisdom of millions of investors worldwide. So, what's an investor to do? Well, instead of trying to time the market, consider adopting a strategy that works in both bull and bear markets. This is where concepts like pound cost averaging come in handy. It's a bit like buying your groceries every week, regardless of whether prices are up or down. Over time, you average out the costs. In investment terms, this means regularly investing a fixed amount, regardless of what the market is doing. During bear markets, your money buys more shares when prices are low. And during bull markets, you benefit from the rising prices of the shares you already own. Okay, so let's look at a quick example. Say you invest £100 every month in a stock market index fund. In a bear market month, when prices are low, your £100 might buy 10 shares. In a bull market month, when prices are higher, your £100 might only buy you 5 shares. Over time, you're buying more shares when they're cheaper and fewer when they're more expensive, potentially lowering your average cost per share. And just to say, if you found this tip helpful, please subscribe to our channel for more bite-sized economics and investment insights like this. Another key strategy is diversification, or as I like to call it, not putting all your eggs in one basket. By spreading your investment, you can potentially reduce the impact of the market swings on your overall portfolio. So think of it like a well-balanced diet. Just as you wouldn't eat only one type of food, no matter how much you like pizza, you shouldn't invest in only one type of asset or sector. A mix of stocks, bonds, real estate, and perhaps even a sprinkle of commodities can help create a more resilient portfolio. Now, let's talk about some real-world examples of bull and bear markets. One of the most famous bull markets in recent history started in March 2009 after the 2008 financial crisis and lasted until the COVID-19 pandemic hit in early 2020. During this period, the S&P 500 index in the US grew by over 400%. On the flip side, one of the most severe bear markets occurred during the Great Depression. From September 1929 to July 1932, the S&P 500 fell by a whopping 86%. More recently, we saw a sharp but short-lived bear market in early 2020 due to the COVID-19 pandemic. But here's an interesting economic tidbit for you. Bear markets tend to be shorter than bull markets. So on average, bear markets last about 10 months, while bull markets can run for several years. And this brings us to an important point. Market cycles are a normal part of the economic landscape. Just as the weather goes through its seasons, the market goes through its cycles of growth and contraction. The key is to be prepared for both. So, how can you prepare? Here are a few steps. Have a long-term perspective. Don't let short-term market movements spook you. If you're investing for a goal that's 10, 20, or even 30 years away, short-term volatility matters less. Keep some cash on hand. Having an emergency fund can prevent you from having to sell investments at a loss if you need money during a bear market. Rebalance regularly. So this means adjusting your portfolio back to your target asset allocation. It can help you automatically buy low and sell high as different assets perform differently over time. Consider your risk tolerance. Make sure your investment strategy aligns with how much risk you're comfortable taking. There's absolutely no point in losing sleep over your investments. And finally, keep learning. The more you understand about how markets work, the better equipped you'll be to make informed decisions. Remember, bull and bear markets are normal parts of the economic cycle. Just like the British weather, if you wait long enough, it will change. The key is to have a solid long-term investment strategy that can weather these changes. Now, let's address a common question, which is, should you invest differently in a bull or bear market? Now, my answer might surprise you. Not necessarily. If you have a well-diversified portfolio aligned with your long-term goals and risk tolerance, major changes usually aren't needed. That said, bull and bear markets can present different opportunities, as we talked about earlier. In a bull market, you might look for growth opportunities in sectors benefiting from economic expansion, and in a bear market, you might focus more on value investing, so that's looking for quality companies trading at a discount. But remember, trying to dramatically shift your strategy based on market conditions is a form of market timing, which, as we discussed earlier, is incredibly difficult to do successfully. Before we wrap up, let's touch on a crucial point that we shouldn't forget: the psychological aspect of investing. Bull and bear markets don't just affect our portfolios, they affect our emotions too. It's easy to feel euphoric during a bull market and discouraged during a bear market. But making investment decisions based on emotions is often a recipe for poor outcomes. This is where having a solid investment plan comes in handy. It's like having a map when you're navigating unfamiliar territory. Your plan can help guide your decisions regardless of whether the market is bullish or bearish. I hope this video helped simplify bull and bear markets for you. And hey, I'm curious, what's your go-to strategy for navigating market ups and downs? Do you change your approach, or do you tend to stick to your guns no matter what? Let me know in the comments below. Thanks for watching, and I'll see you in the next video.